Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Hello, and thank you for joining the latest edition of our Fixed Interest podcast series. My name's Ed Parker. I'm the head of sovereign research at Fitch Ratings. I'm joined today by Brian Coulton, Fitch's chief economist. In this episode, we'll be discussing the latest edition of our Global Economic Outlook. So, Brian, the subtitle of today's GEO, or this quarter's GEO, is Surging IT Investment and Booming Equity Markets Cushion US Slowdown. That sounds a bit more of a positive narrative than more recent GEOs, and there's less on US tariffs this time. So, why don't we kick off with your thoughts on the impact of the AI boom and the other main messages from this quarter's GEO?
Yeah, thanks, Ed. Yeah, it is a more positive tone. It's not because we're any less negative on the impact of tariffs. It's really, whenever you have a sort of technological breakthrough, you're never quite sure how that's going to manifest itself in terms of its impact on the economy, the scale of that impact. But what seems to be going on is that the AI revolution is now translating into significant amounts of capex that we really just hadn't factored into our earlier forecasts. So we're now looking for IT equipment and software investment in the US economy. Looks like we're going to have a 15% increase in that in 2025 on 2024. Now, when we're looking at the numbers we've had today, we're looking at the plans of the hyperscaler companies to invest. That's a $200 billion increment in capex. And remember, one of the mechanisms through which he thought tariffs would affect the U.S. economy negatively was that it would create the uncertainty it created would be weighing on private investment. And now that we've just had to revise up our U.S. capex forecast because we're looking at these numbers. They're so strong. So this is going to add sort of 0.7 percentage points to U.S. GDP growth this year, which really wasn't something we'd factored in last year. So it's just the numbers are speaking for themselves. So that's a pretty key message. I think the other point to reinforce, and this is something sort of inspired by your latest fiscal debt sustainability monitor, is just the size of the fiscal support from the world's largest economies. It's just massive. So when we're adding up the US and the Chinese general government fiscal deficits, using your numbers, translating that back into a US dollar equivalent, we're talking $4 trillion this year, $4 trillion next year. So that's an enormous amount of support being placed into the two largest economies. And now we've got Germany next year has got to be also expanding fiscal position. So I think that's having a more of a cushioning impact than probably we'd factored in before as well.
And you also highlight the US and global equity market boom. So what impact is that having on growth? And there's increasing talk about a potential equity market and AI bubble. So what's your take on that? And if we were to have a major correction, what would be the implications for growth?
Yeah, again, when we're putting together our GEO forecasts, we tend to sort of take a bit of a sort of neutral approach to our predictions of where the stock market's going to go. But clearly that wasn't bullish enough, and the US equity markets rebounded in a way that we didn't anticipate. And so we've done a lot of figuring in this GEO as to sort of the scale of the sort of wealth effect that we may be kind of getting from what's happened to equities and the surge that we've seen in the S&P 500, but also globally. And putting it all together, looking at the kind of academic evidence on sort of how big the impact is, and even though in the US the sort of standard elasticity that people look at is maybe 2 or 3 cents in the dollar for each gain in equity wealth, the gain has been so big that we think maybe that's adding 0.3, 0.4% to US consumer spending. Obviously, US consumer spending is the biggest single demand component in the world economy, so it's having a big impact. Now, obviously, when we look at valuation metrics, it's really hard to find one that doesn't suggest the the US stock market is looking richly valued. So there's definitely a vulnerability there, and that is something that could weaken consumption. And that's definitely a downside risk. But I do think, going back to the sort of previous question, the AI investment, that looks like it's got momentum. Whatever happens to the market, I don't think these companies are going to down tools on these data center investments just because the stock market weakens. So definitely a negative risk there to the consumer outlook. But if the stock market stays where it is, there's probably still some more of this wealth effect to come through.
Then let's turn to China. The GEO flags the unprecedented decline in gross investment in China. So what's driving that and what are the implications? And given that investment accounts for, about 40% of GDP in China, if that's declining, then doesn't that make it pretty difficult to get to overall growth of 4 to 5%? Particularly if consumption's subdued and it's maybe difficult to see the momentum in exports continuing. And then from time to time in China, there's increasing talks about the quality of the data. Is that also part of the story at the moment?
Yeah, it's been interesting. When we first saw these fixed asset numbers turn negative, we didn't really believe it because it's like, it had just been real estate, but then suddenly we started to see a few months ago all the other elements of fixed asset investment that declined as well. We've seen some commentary out there was suggesting, this is just a statistical artifact. China's now sort of understating its growth, which seems a bit of a stretch to us. And as we looked into the numbers, this does feel real. I mean, we've had several months now of fixed asset investment declining. We've looked into some of the differences between the fixed asset investment series and the official capex data that goes into the GDP numbers, but we think the official capex numbers are also negative in real terms. So you're absolutely right. If it's 40% of GDP, consumption growth is weak, net trade is probably not going to make the contribution it has been. That would suggest it looks very, very hard to achieve even the 4%, which is sort of now a bit of a flaw for the authorities on growth. The reason we do expect to get growth at those numbers, and remember, we haven't upgraded our China forecast this time. We're still at 4.1% for next year. So growth's going to be close to 5% this year. So quite a slowdown. We've not revised that, even though we're more optimistic now on the US and the global economy. The reason we can still get to a number like 4% is that we don't think that these negative numbers are going to last for that long. I think a lot of what's been driving this is that there's been anti-involution campaign that the Chinese authorities announced several months ago, suggesting there's overcapacity, and I think the message has gone out to some of the local governments that they shouldn't be doing anywhere near as much investing as they are. But I think what's happened is that maybe that message has been taken too literally, and we're now looking at sort of a kind of what looks like a temporary fiscal tightening, which I don't think is consistent. So our assumption is that by sort of Q2 of next year, we'll start to see the investment numbers pick up again. So we've still got positive growth next year of sort of 1.5-2% in real capex. So, but that's based on the assumption that the policy approach here will change. If that doesn't happen, we get negative capex. Yeah, you can't get to 4%. It just doesn't add up.
Yeah. And then turning to the Eurozone, I think you revised up your growth forecast for both this year and 2026. So, what's going right in Europe at the moment? Is it that we're sort of less concerned now about the impact of US tariffs, or you mentioned earlier the German fiscal stimulus? Is that coming through and really starting to improve the outlook?
Yeah, I think maybe to go back to the assumption we made in our previous forecast that we'd seen pretty good numbers coming out of the Eurozone for the first half of the year. We sort of put a lot of that down to a sort of front running of the US tariffs. So European exporters getting the stuff across to the US before the tariff hikes kicked in. And so what we'd factored into those forecasts was that there would be a kind of payback for that in the third quarter. And it just didn't happen. We had the numbers and GDP was positive. We've actually, the final numbers have been revised by a bit more than the 0.2 we had in the GEO. It's now 0.3. And so we haven't had that any evidence that negative payback is happening. When we look into the details, a lot of that strength in the first half was the smaller economies, particularly Ireland. But again, their exports have been holding up. It looks like some of the pickup in export growth is wasn't related to the forestalling. Very strong pharmaceutical exports seem to be continuing. And so that's part of the story. Is this sort of export growth in the smaller economies? But what we're also seeing very clearly now in the numbers is the benefits of the early monetary easing by the ECB. We're seeing credit growth pick up. Our measure of the credit impulse, which is very well correlated with private demand, has turned around quite strongly. We're seeing housing markets stabilise and improve. House prices up, really quite strongly in places like Spain. So the sort of monetary credit easing is definitely helping, and I think we're factoring a bit of that support going forward. And on Germany, it's not so much that the fiscal numbers are coming through. I mean, the German numbers are still weak on growth. It's been France and the smaller economies that we've revised up. But I think we've got more confidence now in what the scale of that easing is going to be. We've got our own numbers that you guys have published in the comparator. We've got the IMF's measure of the underlying German fiscal balance widening by 1% of GDP this year and next year. 2026 and 2027. That 1% easing, most of the sort of elasticities or the fiscal multipliers that are sort of published by the European Commission, used by the IMF, would suggest you maybe get 0.6, 0.7% boost to growth. We've been a bit more cautious than that, 0.5, but that's still a bit more than we'd factored in last time. And we really only had sort of very broad kind of understanding of the sort of the scale of the fiscal easing over a kind of a sort of 5-year horizon. I think we got more specifics there, and so we've been a bit more. I think we're a bit more confident that we're going to get that effect going forward.
Finally, what does this all mean for monetary policy? And in particular, what's your call on the Fed as they look to balance their twin policy mandate? And for 2026, I guess one of the downside risks is if we see more persistent inflation in the US, perhaps related to the impact of tariffs coming through, the tightness in the labor market given the immigration situation, or strains from the AI boom. So could we see a sort of inflationary scenario in the US and potentially no cuts in Fed rates at all in 2026?
Excellent. Let me start by talking a bit about the sort of a couple of broader global monetary themes. I think that the loosening of labour market conditions that we're seeing in Europe, in the UK, but also to some extent in the US, I think is an important development, because it's taken a little bit of pressure off wage growth, which has been something that's been making the central banks a bit more reluctant to kind of bring rates back to neutral. So that's, particularly in the UK, that's one of the reasons we've revised our Bank of England forecast. We've got an extra cut next year relative to what we were saying in September. We've revised up UK unemployment forecast quite significantly. Now, we're also seeing that loosening labour market to some extent in the US, but not as much. So, the unemployment vacancy ratio has been broadly stable in the last few months. Wage growth hasn't really been coming down very much, and we've still got services inflation quite high. You look at US core inflation, it's been edging up in the last few months, 3.3% annualized on the CPI, 3% on the PCE. That's definitely above the Fed's target, no doubt about it. And when you look at the rationale for the cuts in September and October back to back, it was all about the risks that the labour market would weaken more rapidly. Well, we've since had payrolls data, which was pretty decent for September. The jobless claims have been okay. Q3 consumer spending was 2.7% annualized. So some of those downside risks to activity and the labour market the Fed was worried about don't really seem to be so strong. So we think there's going to be a slowdown in the pace of easing going forward relative to those back-to-back cuts that we had in September and October. Very close call whether they cut in December. We said in the GEO that they wouldn't, but it's very finely balanced. But we do think as we get into the first half of next year, the Fed's going to be a bit more cautious at bringing rates back to neutral, just to make sure that we don't get a bigger tariff impact than they're factoring in. But in terms of your question, there definitely is an upside scenario here. Where the AI investment could be even stronger than we factored in. Maybe we get a more powerful consumer wealth effect. There is quite a bit of significant fiscal easing next year. Significant widening of the fiscal deficit. We think it's going to boost growth. I think there is a scenario also where credit growth starts to pick up. It's not been that strong in the US recently. If all those things kick in, and we're not looking at the sort of around 2% numbers that we're publishing, it is quite possible that the Fed feels that they rather than bring rates back to neutral slowly, they need to keep rates above neutral for a little bit longer. It's not our base case, but it's definitely a significant possibility that we get bigger inflation concerns in the US as growth turns out stronger, and the Fed becomes a lot more cautious about cutting rates.
Well, thank you, Brian, for your insights, and thank you all for listening.
Subscribe to Fixed Interests wherever you get your podcasts.